Whether you're dreaming of a retirement with sand between your toes and a cold one in your hand, hitting the road to chase the winds of adventure, or spending time with your grandchildren, this show is intended to help you get there. Welcome to Coasting in Retirement with your host, Josh Knoll. You've worked too hard throughout your career to spend your retirement worrying. So sit back, kick up your feet, because we've got lots of financial tips and tricks to share to help you get exactly where you want to be. Here's Josh.
I'm your host, Josh Knoll, and I'm joined by my co-host, Michelle Lee Melton. Michelle, how you doing?
I'm hanging in there. I've had some dwelling unit woes as of late. So,
yes.
Yeah.
Last we talked, slab leak. You got water back?
22 days later, and I was able to get water back.
All right.
And I also, congratulations, have asbestos.
Oh, shoot. So.
Yeah. So unrequested
Remodel.
All
right.
However, it's necessary.
That's right. Well, let's see if we can get your mind on something else. We're back with another great show today. We're recording yet again in our still new car smell Jubilee Studios here in Daphne, Alabama.
With running water.
That's right. First, to those of you new to the show, let's do a little background on me. Again, my name is Josh Knoll, and I am a fee-based financial advisor. I hold my FINRA Series 65 securities license, and I am the owner of Gulf Coast Financial Advisors. We are an independent wealth management and financial planning firm based out of downtown Fairhope, Alabama. We serve clients up and down our part of the Gulf Coast. You can find more information on me and Gulf Coast Financial Advisors by visiting our website, gulfcoastfa.com. That's Gulf Coast, FA as in financialadvisor.com. Or feel free to give us a call anytime at 251-327-2124. And don't worry, we'll repeat that contact info several times throughout the show. Speaking of the show, let's get on with it here. So as always, Michelle and I are here today to discuss financial topics relevant to those in or near retirement, living their best life along our part of the Gulf Coast. Today, we're going to discuss the recent bank failures of Silicon Valley Bank, otherwise known as its initials SVB, and another unrelated bank called Signature Bank. We're going to dive into the similarities between these two bank failures, which alarmingly were the second and third largest bank failures in U.S. history. Did you know that, Michelle?
I'm aware.
Yes, after what, WAMU,
2008?
2008, that's right. So it's been a number of years since we've had anything like this, and we just back-to-back, second and third. It's a little alarming.
That was Washington Mutual, but it was known as WAMU.
That's right. And really what we're going to do, and I guess I'd say more importantly, we're going to discuss how these bank implosions were tied to interest rates, to bonds, to inflation, to volatility, to the stock market, to the Fed, all these things, and what investors should be learning from this and possibly doing from all of this unexpected and very sudden banking news. So first, let's talk about interest rates and bonds and why what happened to SVB is so important to just regular investors. First, remember this, bonds have an inverse relationship to interest rates. So when the cost of borrowing money rises, or i.e. interest rates rise, bond prices typically fall, and then of course vice versa, right? Most bonds are going to pay a fixed interest rate that typically is going to become a little more attractive if interest rates fall, which typically drives up demand in the price of the bond. Conversely, if interest rates rise, investors are no longer going to prefer a lower fixed interest rate paid by a bond, and that's going to result in a decline in the price. It's something that's so simple, but even I've been doing this for many years. It still sometimes gets kind of convoluted in my brain. Just think of it this way: if you had two identical offers, let's say a municipal bond from one city or for a city, one of the bonds is paying 7% interest, the other bond's paying 3% interest. Which bond are you going to pay money for, right? So it kind of comes down to that basic principle. These are the basics of how bond prices fall when interest rates rise. There's more demand for the higher priced newer bonds, and with higher demand, you get higher prices. At least that's what I learned through my economics degree at the Harvard of the Midwest, Missouri State University. So what happened with SVB? We're going to touch more on this later in the episode, more in depth. But basically what SVB did was lock in a tremendous amount of money, $80 billion worth apparently, into long-term bonds, particularly from what I've read, 10-plus year maturity mortgage securities, mortgage bonds. And then, of course, what happened is SVB got smashed by rising interest rates. The bank's cash balance, the reason there was so much in these long-term securities is apparently SVB had taken in a tremendous amount of deposits over the last handful of years from the tech industry, and they simply didn't have enough places to loan the money out. So they place these things in long-term bonds. And really what came down to is they made a bad bet. Again, as we'll go into more detail later in this episode, they made a bad bet on interest rates. They got locked into something that if they'd had time to play it out, if there had never been a liquidity event, pretty good chance they'd have been fine. Problem is they had a bank run that basically they was required more cash coming out than they had on hand because banks do not keep all their cash available. And consequently, they were in a position where they had to sell some of these underwater bonds, if you will, or bonds that had lost value anyway. And that spooked. It became a vicious cycle. And next thing you know, we've got a bank run and bye-bye Silicon Valley Bank. Signature Bank appears to have made some of the same mistakes. I think it was, but for everything I've read, it was compounded. To be fair to the listeners, I kind of heard of Silicon Valley Bank before, just because we do some things related to tech. Never heard of Signature Bank out of New York. I guess it was started in New York City. And the funny thing is, I think that Signature Bank, based on New York City, actually had a little bit more involvement with cryptocurrency, which apparently was part of the reason that there was a bank run. And the reason I say it's surprising, because you would think Silicon Valley Bank, which is based in very tech-heavy California, Silicon Valley, San Francisco, all that, you think that they would be the ones that would be a little more aggressive. But by all appearances, it wasn't aggressiveness that brought down SVB. It was more just a really bad bet and poor management on paying attention to interest rates and how they're locking up their excess funds. Where Signature Bank, again, it appears that they maybe had made some of the same mistakes, but I think they were more brought down by their involvement with New York-based real estate. In fact, I read, whereas the tech guys, the hedge funds and things like that out in Silicon Valley are the ones that kind of accelerated bringing down the bank, bringing down SVB. It looks like the pooling of funds by real estate investors out of the New York area-ish were part of a significant reason why Signature Bank went down. So that's kind of the basic reasons. Let's talk about the fundamental things behind all that. First, why did those interest rates rise? Well, they rose because the Federal Reserve decided to raise the Fed funds rate. For those of you all that are not familiar with that, I know you've heard of it loosely. It's basically the rate at which commercial banks borrow and lend their excess reserves to each other overnight. It's not something that actually translates directly to consumers, although, in my opinion, almost any type of interest rate when it comes to banks, bonds, any of that, it's going to be based loosely or at least somewhat directly on the Fed fund rates. The Fed obviously did this to tame recent high inflation. And here's where later in the episode, you're going to hear co-host Michelle and I, or me anyway, pick on the Fed a little bit and also pick on the FDIC a little bit. But why did we have high inflation? Here's my opinion, and I think it's pretty valid, and I don't think I'm the only one that shares this. The Fed kind of kept their Fed fund rates. Again, that's what a lot of things are based upon. They kept it artificially low over the past decade plus. One could argue that in 2008, we're coming out of a real estate crash, a housing crash, the economy is pretty banged up, that there was an argument to be made. Hey, let's get the rates low. Let's get this economy going again. Fine. You could also kind of make the argument that, hey, if we keep the cost of capital low, we're going to have all these investments in new industries, particularly tech, and everybody's going to win. There's going to be more employment. Fair. But there came a point where housing was back. Tech is blowing up. In fact, probably one could argue too much for easy money, cheap money. And instead of starting to, hey, let's start taking some cookies off the table here slowly, they just let it ride. And next thing you know, we've got ridiculously, anybody that lived through the late 70s, early 80s know that we could see a lot worse inflation than what we've seen. But we've got a rapidly rising inflation. And in my opinion, that's a part of the problem is because they took their hand off the steering wheel. It's a lot of times, even though the Fed is supposed to be apolitical, you can kind of see some of the things they do based on how the political winds are blowing. So then tied into what we said in our opening statement on this segment, that all come down. Now we got volatility again. Good grief. I mean, how much volatility in the stock market have we had over the last couple of years? Because investors started getting concerned that regional banks, including some of their own regional banks, some of my clients called about a couple various regional banks, were going to fail. And so what happens when you get that nervousness / sometimes panic, you start seeing people sell. Typically, like in this situation, you saw people selling equities, which is one of the main drivers of your various indexes. That's why you saw a pretty significant correction earlier this week. And you also see a flight, they call it a flight to quality. Sometimes a flight to quality means they're just getting out of equities, getting into cash. Sometimes there's a flight to high quality bonds, which is kind of amazing, the circle of life here, if you will, because long-term bonds, particularly in SVB's case, were kind of the root of the panic. So there you go. One big circle, right? Just money just sloshing all over the place. So before we end our first segment, here's what I want to do. I want to pivot to an offer to our listeners today. And then also just to reiterate, I definitely think you stick around for segment 2 and segment 3. We're going to dive into the headlines related to these bank failures and how it relates to you all of those in or near retirement, and really, honestly, to any investor. And we're also going to have a little bit of fun, poking fun at some of at the government a little bit. We'll be fair with it in segment 3, where we talk about some of the opinions I've had in the past. But before we do that, we're going to pivot. I recently did a comprehensive financial plan proposal for a business owner. He was looking to transition to retirement in his early 60s, had done a great job building his business, putting money away. Just one of the clients, if you're in my line of work as a financial advisor, you just love when people like this walk in the door. They just got such a buttoned up life. It's really impressive. But this particular plan included using both a lot of specialized software as well as expertise and the experience of our team at Gulf Coast Financial Advisors. So I just wanted to share kind of the basics of it. Nothing particular on the client, just the basic plan outline, if you will. Now, I'll repeat this here in a minute, but if you're interested in having a conversation about working through a similar plan, be sure to give us a call at 251-327-2124. And of course, you can always email me at jnull. My first name is Josh, so J. My last name is Null, just like null and void, Null, at gulfcoastfa.com. So anyway, here's the basics of the plan. First, we're putting together a comprehensive financial plan utilizing eMoney, their financial planning software. We use that for the assembly, the presentation, ongoing adjustments, all the things related to this comprehensive financial plan, including sometimes if the client wishes, we can set up a digital central hub that keeps evergreen digital copies of our clients' most important documents. It's in a secure environment. Next, we're going to be doing some basic tax planning. I am not a tax expert. I'm not a CPA or accountant. However, my partner, the guy that works with me quite a bit in our practice, Will Stye, who is a financial advisor by trade but has a CPA background. We're going to do some basic tax planning with his background and using a planning software called Holistaplan. And basically what that does is we're going to look at existing tax returns. We're going to see if we can identify any potential tax savings and anything available phasing in, phasing out to make forward-looking recommendations. We don't do tax preparation. That's for the CPAs and accountants of the world, but we do work hand in hand. A lot of times we'll use this Holistaplan software to have a really neat and productive conversation with our clients and their CPA team. Next, we're going to do a risk tolerance analysis using Riskalyze software. It's fairly well known in our industry, but I used to say I was an X-ray, but now that I know the software better, it's really more like an MRI. It's going to look at your current investment holdings, and it's going to determine how those positions match up with your actual investment goals and your time horizon. And it's pretty cool. It looks at each individual holding, and it really gives you a drilling down. And I'm going to tell you just from experience, it's pretty rare when someone comes in the door where their actual risk tolerance matches up with what they're actually holding. It's a really neat conversation, and it's a great way to come in and make some adjustments to get this thing back in line. And then lastly, we do a lot of income planning. We're going to do a customized income plan using a software called Retire Up. It's basically it uses portfolio data and actual modeling. And so the end result is a solution-based visual roadmap for your income planning. All this stuff's pretty cool. I sound like a giant nerd, right, Michelle? But all this stuff is cool. It's really next level things, and it gives us the tools along with our own experience and expertise. I think that makes our offering fairly unique. Now, these strategies we design, they're used in part to help with income production as well as accounting for inflation and longevity risks. Not only are we trying to match your risk tolerance with your investment holdings, we want to help make sure you don't end up outliving your retirement savings. So again, if you're interested in having that conversation, give us a call, 251-327-2124, or you can find us at our website. That's Gulf, like the Gulf of Mexico, Coast, FA is in financialadvisor.com, gulfcoastfa.com. All right, folks, coming up next, there's always a lot going on in the world, particularly the world of finance, and this past week was certainly an example of big news in finance. So every week, Michelle and I scour what she calls the interwebs for helpful financial articles related to our topic of the day, especially articles that are going to pertain to those in or near retirement. So make sure you join us after the break to hear Michelle and I discuss this week's relevant headlines in our Michelle with the News of the Week segment. Stay tuned.
Hi, I'm Michelle from Coasting in Retirement, a show that you might have heard on Sundays at noon. If you're looking to inflation-proof your retirement and are ready to take that next step, but don't want to wait for one of those upcoming seminars, just give the advisors at Gulf Coast a call today and schedule your no-obligation sit-down with Josh and his team. Maybe it's time for that second opinion after all. Call 251-333-5151 or visit us on the web at gulfcoastfa.com. And make sure to listen on Sundays at noon right here on the Talk 106.5.
Advisory services offered through Prime Capital Investment Advisors, LLC, a federally registered investment advisor. PCIA 6201 College Boulevard, Suite 150, Overland Park, Kansas 66211. PCIA doing business as Prime Capital Wealth Management and Qualified Plan Advisors. PCIA and Gulf Coast Financial Advisors are not affiliated.
Welcome back to Coasting in Retirement. Your host, Josh Knoll here. As we discussed before the break, every week, Michelle and I scour the interwebs for helpful financial articles related to our topic of the day, especially articles that pertain to those in or near retirement. Coasting in Retirement's co-host Michelle and I are going to try to help you all understand and hopefully decipher the deeper meaning of these headlines, or at the very least, maybe provide some context. So without further ado, here's Michelle with the news of the week.
Okay, first up, it's an article that's about the bank failure that kicked off a crazy week. The Verge, which is new, I think, a newer source, it was fun to read, has an article titled, quote, "The tech industry moved fast and broke its most prestigious bank," unquote. Of course, this article is referring to the Silicon Valley Bank you mentioned, or AKA SVB, because everything has to have an abbreviation or an acronym.
Truth.
Yes. Anywho, this article does a great job of breaking down everything that led to SVB's failure, including potential fallout to other industries. But I want to focus on the article using the movie It's a Wonderful Life, which I haven't seen in ages and actually don't really have fond memories of. But anyway,
Not one of my favorites either.
Yeah. But isn't that when the angel gets its wings though? That's the best part that
I
comes
remember
out
the
of
name
that
of the bank, which is kind of, again, I'm a nerd.
I didn't remember being a bank failure or anything.
Right.
Yeah. Okay. So it does compare It's a Wonderful Life to the run on SVB. So Josh, why was there a bank run on SVB, and how does that compare to the bank run depicting in the movie It's a Wonderful Life?
That's great.
Yeah.
All right.
I think this also doesn't it mention ample liquidity?
Yes. Well, let's talk about that. So,
and ample doesn't sound good.
well, okay, here's why.
I think you want flourishing or.
But banks typically, now these numbers, folks, I'm not a banker by any stretch, so these are numbers that I've pulled before in the past just out of curiosity. They could be a little bit off, but more or less, call them smaller banks, if you will. They've only got to hold typically 3 to 5% in reserve. Larger banks, which according to some of the research I did, is banks with more than 110 million or 110.2 million in transaction accounts, they've only got to hold 10%. So what that means is, the money that you're depositing, these banks are allowed to loan out up to 90% in a lot of cases. So the banks use this money to make these loans. Depending on the style of bank, depends on what type of loan it's going to make. If you've got a local regional bank, typically they're investing in the community. They're doing small businesses, mortgages, or home construction, things of that nature. Oh. Bigger businesses are going to do bigger loans to bigger companies, so on and so forth. But they all have kind of this similarity is when the economy falters. And in the movie, It's a Wonderful Life, I believe it was related to mortgages during the Great Depressions,
really?
If I'm wrong. The one thing I remember about the silly movie is it was the Bailey's Building and Loan Company. Don't ask me why I remember that. Or in SVB's case, tech and crypto,
Crypto.
Right. When the things that the bank is making loans against or heavily involved in starts to falter, depositors sometimes start to worry that the bank has enough cash on hand to give their money back. And then once you have more than 10% of these depositors worrying, 20%, 30%, whatever that number may be, there could be what is called a bank panic, a bank run on the bank. And you got all these people asking for their money back, and the bank simply does not have it.
Oops.
The only way they could get it is to call loans, which I think is what Bailey's did in the movie. I think that was the example. They called mortgages.
Well, this bank couldn't even sell itself.
Well, right. Yeah, that should tell you something. The difference between the movie, obviously a fictional bank in the movie, and of course what happened in real life, the main difference is the means and the speed of the communication, and obviously the size of the bank. This was probably the first time, and I want to give credit where credit is due. I don't remember the author, but one author said this is probably the first Twitter-fed bank failure. Because particularly SVB was very heavily involved in tech. Tech people tend to, if they are social media users, they tend to be a lot on Twitter. There's a lot of communication. And basically there was a lot of chatter that people needed to get their deposits out of SVB. Things happened very quickly, and next thing you know, boom, there it is. So we're going to talk about more about why some of the SVB's bad bets on longer-term bonds and securities, but we'll circle back on your next article, because I think we talked about that one enough.
Yeah, well,
right?
Also, you said best bets, which is funny because it said that SVB was founded after a poker game.
Oh, right. I didn't know that.
That was the inception.
That's
That's
probably
questionable.
not good.
Yeah.
That's questionable. All right, what do you got next?
Okay. So we've already established that the failure of Silicon Valley Bank is the second largest bank failure in U.S. history. So right after the WAMU way back in 2008, we also stated that we just saw the third largest bank failure ever with Signature Bank falling over this past weekend. I found a great article on Barron's simply titled "Why Signature Bank Failed." It seems like there are a lot of similarities between the two bank failures, but this article goes into a little more depth about Signature's ties to cryptocurrencies.
Okay.
We've discussed crypto at length, still questionable to me,
Right.
in previous episodes. So tell me what your opinion is as to how crypto plays into this sad, sad story.
Okay, well, first, Michelle, let's we keep referring to a previous episode where we talked about crypto and other things. For you listeners that want to hear our previous episodes, go to Spotify, just look for Coasting in Retirement. We did plus you can go to my website, gulfcoastfa.com, and go to the podcast page. But either way, you're going to find an article where we talked about things that pre-retirees and retirees should probably not have in their portfolio. And we did pick on crypto a little bit. And I think as we've seen over the last several weeks,
Still a mystery to me.
we're not too far off. Now, we were fair and balanced in our discussion. Not enough time to talk about it now. So let's talk about how it relates to what's going on here. Signature Bank is a really, there was similarities to SVB, but the Signature Bank was definitely more aggressive in the crypto space. Their digital asset clients, according to the research I did, made up about 20% of their deposits, which seems really high. And when you had FTX's failure, FTX, we also talked about that in a previous episode. That was a crypto exchange. If you want to learn more, go back to our previous episodes. When that failed, you also had people getting uneasy. I do know that Signature, I don't think anything came of it in time, but the Fed was definitely taking a look to see if there's any money laundering happening around their crypto activity. And I think, if I remember correctly, the Winklevoss twins, do you remember them from Facebook, Michelle?
Yes.
Yeah, I think Signature was a bank that actually was...
I think you're right now that you mentioned
tied
it.
to them. I think they allowed the Winklevoss's crypto exchange to deposit money in Signature. So anyway, when you add all this up, you have other depositors in Signature becoming very concerned about their ability to get to their cash. As we discussed in the last article, banks do not keep a significant part of their cash on hand typically. So the depositors panicked. They made a run. They asked for way more cash than Signature had on hand. And there you go, another bank failure. So the third largest in history on two banks that up until last week, I'm kind of embarrassed to tell you, I've never heard of. You think you would have heard of Silicon Valley.
I knew of Signature New York too.
Okay, yeah, very good.
Because it had New York in the title.
All right, well, what's next?
Okay, so we're going to stay with Barron's, and I believe this article ties into our discussion about long-term bonds, interest rates, and inflation. The article is titled, How SVB Was Doomed by a Bad Bet on a Mortgage Securities and the Fed Rates Hikes. So Josh, when I see mortgage securities, I can kind of make sense of that. But it also helps me go back to 2008.
Well, you probably start thinking of 2008, right?
Right.
Right. When the
And
world learned what a CDO, a mortgage-backed security was, right?
And WAMU.
Yeah, and it almost broke. I mean, literally came very close to breaking the United States banking system, financial system, which would have broken the world at least in some degree. So, all right. So what you're saying, Michelle, in this, you're wanting to know: did the 2008 CDO's mortgage-backed bond thing have anything to do with what happened with SVB? So,
Yes.
From what I can tell, no. So let's do a quick history. The mortgage-backed bonds from 2008 that you're referring to were called still are called CDOs. That's short for collateralized debt obligations. We're going to get nerdy here a little bit, listeners, but a CDO is a derivative. As the name implies, its value is derived from another underlying asset. In this particular case, the majority of them were mortgage loans. These assets become collateral if the loan defaults, which is what happened in mass scale back in 2007, 2008. The problem with the CDOs then that nearly broke our financial system is that bond departments were putting a bunch of subprime mortgages, which to the best of my knowledge don't exist in any substantial way anymore. They were putting these into these CDOs, yet still getting an A rating on the bond from the various rating companies like Moody's. It would be one example. Now, from what I can tell, SVB didn't necessarily make a bunch of bad bets on what we would call junk bonds, or worse, things that maybe oversee some sketchy things, if you will. That didn't appear to be the case. What it looks like is they made a bad bet to the tune of $80 billion on mortgage bonds with 10+ year maturities. And so up until recently, those bonds would have had incorporated relatively low interest rates. So when rates shot up significantly and quickly, the current value of those bonds fell. So now, here's the thing. That does happen. We've been a little bit spoiled the last 10 years, at least with the let's call it lack of volatility in the bond market, if you will. So typically what you do is just hold on to a bond until maturity and you get made whole. But when you've got a bunch of depositors demanding their money back, and as we said earlier, you don't have the cash on hand, which means you've got to fire sell these bonds at a loss. Now you've got a problem.
Not good.
And that's pretty much what happened. So very good. Nice job, Barron's. It's nice to have Barron's in the mix here.
Yeah.
Yeah. What you got next?
Okay. So now that we've introduced a few new websites to our show, shout out to Barron's again and
The Verge, yeah.
Which remind me of the Verve Pipe, that band.
There
I
you
can't
go.
remember what they sang, but
grunge.
I think
Or
maybe
alternative. Yes, not as
adult
good as Winger,
alternative,
but
right?
not as good as hair metal.
Yes. Okay. So we brought on some new websites to our show, but we're going to pivot back to an often reference site with a lot of syllables, Investopedia.
That's right. It's a good one.
Yes. So Investopedia has an article titled The Inverse Relationship Between Interest Rates and Bond Prices. And to be honest, I get that info in this article is important, but compared to the sensationalism of Barron's or The Verge, aka Verve Pipe, this article is a little boring.
Right.
So I'll simply toss it to you. How important is this inverse relationship? And did it have anything to do with the two recent banker splats?
Well,
And then I also have never heard of zero coupon
bonds.
bonds.
That's right.
Yeah.
Yeah. Now we're getting old school on this. We talked about laddering CDs and bonds. Last week or the week before?
Well, yeah.
So first, let's do this. Bonds have an inverse relationship to interest rates. What that means is when the cost of borrowing money rises, which means interest rates are rising, bond prices typically fall. And then vice versa. When the interest rates lower, bond prices go up, so on and so forth. Now, most bonds will pay a fixed interest rate that becomes a little bit more attractive if interest rates fall, because that's going to drive up the demand of the bond and the price of the bond. Again, conversely, on the other side of that, if interest rates rise, investors will probably no longer prefer the lower fixed interest rate paid by the bond, resulting in a decline in its price. The easiest way to think about this is this way. If you had one bond paying 7%, Michelle, and the other bond paying 3%, which bond would you pay more money for?
Did you say 2% or 3%?
7 or 3.
7.
Right. Okay. Keep it that simple when you're thinking about this. So as they discussed with this article, SVB didn't just have lower interest rate bonds. It had a ton of them, $80 billion worth, and it had them for long maturities at what at the time was probably a defined interest rate. But as the Fed started raising interest rates, those were to be considered very low rates, and compound that with the volume and the length. Typically, depositors in a bank that don't know or don't care, And a bank like SVB, if they could have given time to hold on until some of those bonds started maturing, they probably would have made it out just fine. But banks borrow long and they lend short. And unfortunately, SVB's leadership took this basic maxim to the extreme, and they got caught up in a good old-fashioned bank run. Now, for individual investors, the main takeaway is this. Sometimes it pays to look long at equities, but possibly look a little shorter at bonds, particularly in a rising inflation and interest rate environment. Okay? Very good. I like that article, even though it was a little bit boring, but it's very, and folks, just so you know, we always do a transcription of our show. So if you want to go on our website after we've run this on the radio, we post the episode with transcription, including links to these articles that we reference. It's on the website. Very good. What's next, Michelle?
Okay, we're still with Investopedia, and so we'll call it Twinsies articles, okay? And we had 2 from Barron, so it's Twinsies week.
That's right.
Sweet. So hot off the presses is an article with an absurd amount of words in the title. It is exhausting. These editors need to think about brevity. Okay. Anyway, take a deep breath. Bear with me.
What we got?
The article is titled U.S. Bond Yields Post Biggest One-Day Drop Since Financial Crisis as Investors Seek Safety.
Do you need to take a break? Do you need some water?
I need a nap. So I can't even come up with anything because it's sapped the energy out of me. So just tell us what you think.
Okay. So what it means when investors seek safety, particularly in the bond market, they are what happens in times like these. It's going to be kind of interesting to listeners. One of the reasons that SVB and to some degree Signature Bank went under was that because they bought bonds. Who knows the quality? From all appearances, the bonds were fine. I don't know that for a fact, but just from general research, it doesn't look like they were tied. They were tied up in anything super sketchy. They just bought bonds with too long of maturities and too low of interest rates. Okay, so you would think, oh my gosh, everybody's just going to flight away from bonds. It led to the second and third largest bank collapse in history. That's actually not the case. What happens in times like these is people get a little more spooked on the equity side. They flood money into bonds. Bonds right now are fairly attractive with interest rates because interest rates have been high because the Fed has raised the Fed fund rates, which is not necessarily directly tied to the bond rate, but there is some correlation there. And the bonds are attractive. You've got quality bonds out there, and people have kind of flooded that. It's part of flight to quality, and it's also part of flight to some guarantees, because if you buy a bond that's a federal, municipality, corporation, blue blood, all that, typically you're buying something that is going to pay whatever interest rate it says it is, and you don't have a ton of exposure for something going under, and that's flight to quality. So yeah, it's kind of funny. Bonds were part of the reason that this all mess happened, but in some degrees they've kind of benefited. It's kind of strange. So you got one more?
Yes. Well, you have one more.
I picked this one.
Yeah, because I gave you the opportunity to pick something, and here we are. Back to Kiplinger.
Kip Winger.
Well, your bromance continues.
That's right.
It knows no bounds or ends.
My hair looks a little Kip Winger-ish right now with this humidity.
The hair's not bad. The hair's not that bad. Okay. Okay. All right. So in all seriousness, Kiplinger has an article titled The Risk with Fixed Index Annuities. And I feel that Kiplinger, as usual, does a good job of balanced and fair analysis.
Agreed.
Yeah. They do mention a particular feature of fixed index annuities. What would that be? FIAs, if it was short, that I think ties into our topic today.
FIAs. I'm not
FIAs?
sure. Yeah,
Okay.
you're thinking SPIAs, but yeah. Same.
Yeah.
All
right.
You're not too far off.
Okay, so quote, annuities can be, here's actually the quote, hedge against market volatility. Whew, unquote. Well, you got me to say Kiplinger and volatility.
In the same paragraph.
In the same paragraph.
I
and I
did my
actually
work.
volunteered liquidity earlier upon myself. I did that to myself, which I also find kind of difficult to say sometimes. Anyway, got it do in the same paragraph. So what do you think about this FIA article?
Well, listeners to the show first, we have a little bit of a running joke about Kiplinger. Michelle and I are both children of the 80s, so hair metal was definitely part of our youth, and Winger was a band that is,
Yes.
their most popular song is rightfully
Which
probably
turns
been
out
canceled.
Is from the United States. I thought for sure they were Canadian.
No, they seem like it, but they're
Yeah.
not. And then Michelle likes volatility, and I have trouble with certain words because of my overbite. But here we are. So, fixed index annuities. We're just going to really briefly talk about this. and why they potentially might be an option for pre-retirees and retirees that more or less are kind of tired of seeing their account balances go up and down, and are also maybe looking for some type of income feature, so on and so forth. Now, a fixed index annuity is something that really needs to be thoroughly researched before they are purchased. You need to know the period of time that your money is going to be tied up with surrender charges. You need to know all the things that you can get your hands around. So this is just a general discussion. In general, what they do is they track an index. So they take your principal, or your premium as it's called, and they're going to they're going to track an index called, say, the S&P 500. If the S&P 500 goes up, let's call it 12% for the year, which hopefully we'll see that again sometime. But let's say the S&P 500 goes up 12%. That fixed index annuity is going to have some type of cap on the amount of gain that it's going to share with you in that. It's called the cap rate. 5%, 6%, 7%, 8%. It is to be dependent upon some of the other features that are in that fixed index annuity. Well, you think, well, that sucks. I'm leaving gains on the table. And you are. In exchange, what you get is a 0% floor, where in theory, the idea is your principal, again, your premium, never goes below 0%. Well, why does that matter? What if the S&P is down 12% for the year? Your losses, again, in theory, per contractor, stop at 0%. There's a bunch of other features that can go in with an FIA for income and things of that nature. It's definitely worth a conversation, and it's one that we'd be happy to have with you all. Our contact, you can find us on our website at gulfcoastfa.com, or you always call us at 251-327-2124. Michelle, great job as always with the headlines.
Thank you.
Right. These are all important pieces of information that impacts those in or near retirement. Now, listeners, if you have questions around these topics, again, reach out to us, gulfcoastfa.com, or call us 251-327-2124. It's a free, no obligation conversation, or we can set up, again, free, no obligation appointment. So, folks, coming up after the break, we get to have a little fun and probably get picked on a little bit by my co-host, Michelle. Mm-hmm. That's right. In our next segment, we call it Where Josh Nailed It, where Josh was a little off. So as someone that has always had strong opinions, and often public opinions, I think it's important to hold myself accountable for the things that I've said that didn't quite stick the landing. But to be fair, we also get to discuss where my often skeptical viewpoints prove to be pretty accurate. I'll remind our listeners, I'm originally from the Show Me state of Missouri. And Michelle, what does show me mean?
You have to prove it.
It means don't tell me, show me, buddy.
That's right.
That's right. Stay tuned.
Hi, Michelle here. If you're looking to inflation-proof your retirement and are ready to take that next step, but don't want to wait for one of those upcoming seminars, just give the advisors at Gulf Coast Financial Advisors a call today and schedule your no-obligation in-person review with Josh and his team. Maybe it's time for that second opinion. Make sure to call 251-333-5151 or visit us on the web at gulfcoastfa.com. That's GULFCOASTFA as in financialadvisors.com.
Advisory services offered through Prime Capital Investment Advisors, LLC, a federally registered investment advisor. PCIA 6201 College Boulevard, Suite 150, Overland Park, Kansas 66211. PCIA doing business as Prime Capital Wealth Management and Qualified Plan Advisors. PCIA and Gulf Coast Financial Advisors are not affiliated.
Welcome back. So the point of Coasting Retirement is to offer general financial guidance and education to those in or near retirement, which means I often give my professional opinion. And while I'm proud of the thought, care, and due diligence I put into giving my professional opinion, both on this show and in my financial planning practice, I'm also human, and that means I don't always stick the landing perfectly. So each week, Michelle and I get to poke a little fun at myself, by admitting to any thoughts or opinions I put out there that weren't 100% on point. But again, as I said in before the break, this segment has to be fair. So I also get to point out some of my thoughts and opinions that were pretty accurate. We call this segment Where Josh Nailed It, where Josh was a little off. All right, Michelle, what's first?
Okay, Josh, with the recent bank failures of Silicon Valley Bank and Signature Bank, the FDIC insured deposit amount of $250,000 is suddenly on many banks' customers' minds, particularly in business owners. So I did some research and found out that it took the FDIC 28 years to make its last increase, going from what seems like a measly $100,000 in 1980
right.
to $250,000 just in 2008. So That seems pretty weak sauce to me at first glance. I was kind of astonished by that.
It took him forever to do the 100,000 too. If you look at the history of it.
Oh my gosh. Okay. So anyway, you stated for the past several years that the FDIC needs to increase its coverage again and figure out a way to separate business accounts from personal accounts, which totally makes sense to me too, with its coverage. So, did you nail it on this opinion, or were you a little off?
Well, I think it's easy to say now, especially nailed it, right? I think the SVB and Signature Bank failures are a prime example of why they need to raise it. So think about it this way. There's a couple of things here. One, even since 2008, there's been quite a bit of inflation, particularly over the last year. And on top of that, there's been a huge increase in money supply. I don't know how many more trillions or billions of dollars are in the money supply since then, but I bet it's significant, right?
Yes.
And with all that said, it's not uncommon for someone to have a business owner or professional or retiree or pre-retiree. It's not uncommon for someone to have excess of $250,000 at a bank anymore, right? And what happens when the FDIC doesn't address this stuff beforehand of raising this and getting a little bit more in lock with what's going on, what they get put into is a position that they're finding themselves with SVB is where they are having to but they're going to make all the depositors whole. And that really sets a dangerous and unrealistic precedent that if they just get ahead of it and figure out a way, what is an individual account, what's a business account, these are different rules, these are higher limits. Because now, I mean, if you took what they did with SVB, Michelle, it looks like there is no limit. It is limitless on the bailout that they're willing to deposit. That's a dangerous place to be. So 100% nailed it. They're going to, and I think this may actually address it and push them to make some changes. So
FDIC need to get busy.
That's right.
Okay.
All right, what's next?
All right. So you've also stated in this radio show that the Federal Reserve was not doing anyone any true favors by keeping the interest rates so artificially low for so many years. Consequently, they have had to raise rates at an incredibly quick pace that appears to have caused some chaos in the economy. Faux show. Your opinion is that the Federal Reserve did not do a great job with managing interest rates. What do you think? Nailed it or a little off?
Well, so here we are picking on both the FDIC and the Federal Reserve, which, to be fair, are run by very competent, very professional people. So I want to be fair with that. You know, here I'm just a financial advisor in downtown Fairhope, but I do think I nailed it again. And here's my analogy. I'll do an analogy as being a dad. So let's say for years I put cookies out on the counter, and I look the other way anytime one of my kids grabs one or two or three of them or whatever, fills up on them. And every day I just keep refilling the cookie jar. So then one day what happens? My kids are dealing with weight issues, maybe diabetes, maybe they got bad teeth. And so I understandably yank the cookie jar off the table and I replace it with, I don't know, kale.
Kale, yeah.
Yeah, that's right. That's one of Michelle's favorite, kale. But then I turn around and I have the nerve to point to my kids and say, why didn't you just eat only one cookie per day? All right, so here's what I mean by that. The Fed kept rates artificially low. There was an argument to be made 2009, 2010, 2011, where they're trying to get the economy going back on track. The economy ended up being fine. And I guess you could argue that they used cheap money to fuel our tech boom, which matters in the global economy. That's all fine. But instead of being the adult in the room, my opinion, and saying, hey, we got to take at least few of these cookies off the table for a while and let the sugar levels of this economy go down a little bit. What they did is they just yanked the whole stinking thing, threw some kale at us, and then they have the nerve to tell us it's our fault for doing these things. Now, listen, the people are going to do what they're incentivized to do, and when money is cheap, they're going to go at it too hard. And when you just go 180 their direction, the kids are going to panic when they start having to eat kale, and that's what's happening right now. So, very good, nice one,
yummy kale,
nailed it.
Okay. Josh, you were in the real estate in the 2000s, and if memory serves me right, you actually did business with a bank that was taken over by the FDIC.
Crazy experience.
All right. Well, with that experience and with the Dodd-Frank Act adding extra stress bank to test, did you ever imagine at that time that you'd see bank failures like we just did this past week? So
the first 2 points you had where we're getting to pick on FDIC and the Federal Reserve, where I felt like I nailed it. This one, to be honest, I was a little off. I sure as heck didn't think we'd see the second and third largest bank failures ever, when we've got a relatively strong stock market, we've got relatively strong employment. We had a lot of things pointing, even though we had
a week.
Right, just bam, 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 right. So no, I definitely think I was a little off, and it goes back to what you thought were, again, the adults in the room. Dodd-Frank. I'm not saying I'm a fan or not a fan. I know a little bit about it, but I'm not a banker. But I do know that it seemed like that some of the funny business that happened back in the 2006 to 2008 range, if you will, had been kind of cleaned up out of banks. And I didn't think we'd see bank failures like this. So yeah, it definitely, just like any other regular consumer, it concerned me. I'm glad that we did this episode. I'm also glad you had to do some research to find out that.
I agree, because it's frightening at first glance, but then when you look at the nuts and bolts of why they did, it's like I can see it.
Right.
A little bit
well,
more.
and you can also see where SVB in a parallel alternative universe didn't have to go under.
Right.
I mean, so a lot of it was timing.
Yeah.
Right. So very good. Yeah. A little off on that one, unfortunately.
But like you said, when there's too much money being flung around, I don't know.
Yeah.
Bad things are probably going to happen.
It gets too easy.
Yeah. Okay.
All right. What's next?
All right. So you've also gone on record that cryptocurrency has significant places in pre-retirees and retirees' portfolios. With some of the recent bank failures being attributed to their ties to the crypto industry, do you feel that you're still nailing it with your skepticism of crypto, or are you a little off? Do you love it? Has it changed?
Well, that's a meatball pitch right down the middle. I mean, I'm going to nail this one. So again, to be fair to the crypto world, because anybody that just kind of parachutes into our episode is going to think that we're just sitting here bashing crypto. Right. Not necessarily. I mean, Michelle and I've been on Earth long enough that we've seen technology come in that we didn't think would ever stick around, and next thing we know, it's changing everything. I mean, we're from a time when the phone was on the wall. The thought of everybody standing or walking around staring at a screen.
I actually walk around with cash. I call it wham, walking around money, because it's real.
So to be fair, we've seen a lot of change. So you want to not just be the get off my lawn guy when it comes to this stuff. And who knows? Maybe there is a use case eventually for blockchain.
Nah.
We'll see. Who knows, right? But even so, I've always held that no strong sovereign nation was ever going to let private citizens create their own viable currency. And plus you had that speculation in that space was literally, in my opinion, no better than tulip mania from whatever many centuries ago that was. So this one, I nailed it. Particularly, folks, to be hyper specific, pre-retirees and retirees, man, you don't need to get in stuff where literally it can go, there's hard to prove the underlying value of it to begin with, and it can go to zero so quickly, it just melts your face off. So stay away. All right, nailed it. Boom, out of the park. What's next?
So using annuities as a hedge against potential losses in stock market volatility.
Yes.
What was your opinion in the past? What is your opinion now? And did you nail it, or were you a little off with said opinion? And congratulations to me for vitality. Dang.
Volatility.
I almost made it.
You were almost there.
I went too far.
You did. You took it one volatility. Your volatility got out of hand.
On my own, and yeah.
Well, so all right. So here's the thing. To be fair, in the past, coming up on the insurance side, you learn to have earn a healthy skepticism of the insurance side. But once you really start getting into the A quality companies, and you start looking at 1 plus 2, you get older. Your views on risk and gains and things like that are very different in your 20s, your 30s, and your 40s, as they should be. But what has happened, particularly in the last couple of years, it's been scratch and claw to get gains in investment portfolios. And there's been a lot of volatility. There's been a lot up and down. When you're 30 and you see your account go up and down, and honestly, that's a buying opportunity. At the very least, hang tight. But when you start getting into pre-retiree range, 5 years or less to retirement, or you're in retirement, no longer making an income or the same income you were, you're more concerned about losing money than you are about having gains. And not that they're a solution for everybody, but there definitely is a place for using these things to have some capital preservation, possibly some income production. They're not necessarily great at, and we've talked about this in the past. Again, you can go to Spotify or my website, see our past episode. In my opinion, they're not great at capital appreciation. That's not really what they're designed for. If it's being sold to you that way, I would be very careful. They're really better for capital preservation and income production, but they definitely have a place. So I would say, Michelle, I was a little off, but like with everything else, I've evolved, I've learned, I've gotten older.
That's
right?
Nice.
All right. Well, very good. Listeners, once again, of course, I didn't totally nail it with all my opinions. That would be boring and probably a little cocky to say that. Yeah, I think so.
Boring,
right. I did have valid reasons when I was a little off. And of course, I'm learning to be more open-minded. So now to our listeners that have more questions about bonds, the things we talked about today, bonds, investments, inflation, interest rates, annuities, all this stuff, we invite you to reach out. You can find us at our website, gulfcoastfa.com, as GULFCOAST, FA is in financialadvisor.com, or you can call us to have a conversation or set an appointment at 251-327-2124. That's 251-327-2124.
Retirement is full of decisions you need to make before you actually retire. When should you take Social Security? How are you going to pay for medical expenses and long-term care? Are you comfortable with the amount of risk you're taking with your savings? Join Gulf Coast Financial Advisors as they lead a discussion about these factors and more. All while the Gulf Coast team treats you to a complimentary dinner at the Balcony in Fairhope. You pick the date, Tuesday, December 6th or Wednesday, December 7th at 6:30. Reservations are required, so call 251-333-5151 to reserve your seat today. That's 251-333-5151. Seating is limited, so call now. Gulf Coast Financial Advisors, 251-333-5151.
Advisory services offered through Prime Capital Investment Advisors, LLC, a federally registered investment advisor. PCIA 6201 College Boulevard, Suite 150, Overland Park, Kansas 66211. PCIA doing business as Prime Capital Wealth Management and Qualified Plan Advisors. PCIA and Gulf Coast Financial Advisors are not affiliated.
All right, welcome back to Coasting in Retirement. Josh Null here. Well, another great show today. Great job, everybody. Some weeks we have a little extra time where we can dip into our listeners' mailbag. Typically, those are questions sent to us through the show, either through the website or through my email, jnull@gulfcoastfa.com. I know we got just a couple quick minutes, so let's dive into one I can answer fairly quickly. Coming to us, Nicole from Daphne. Hey, Nicole, how you doing? She wants to know, Josh, you said in the past that sometimes it's better to hold equities long, buy equities long, and possibly do bonds short. What do you mean by that? Well, that's a great question, Nicole. And in fact, it's kind of ties together some of the things we talked about here in this particular episode. Here's what we mean. On the equity side. All right. So first, what's an equity? Equity is stock. Mutual funds that have stocks in them, individual stocks, ETFs, they are pieces of ownership of a publicly traded company. Now, for sake of argument and time, we're talking about, let's say fairly well-known equities, things that you would buy and sell on NASDAQ or the New York Stock Exchange. So with those, what you're looking at when I say, hey, buy long on those, is you're looking for quality companies. If they're in tech, maybe they're in growth, but there's some type of profit and loss, there's some type of potential, there's a valid business model underneath that. So if you're buying that type of equity, then what you really want to do, if you believe in the company and you believe in the future of the company, you want to hold on to it through some of the nonsense that comes here and there everywhere with the news that kind of knocks things sideways on the stock market on any given day, volatility, right? Now bonds, on the other hand, the interest rates were held, I would say, artificially low by the Fed for a number of years. So bonds, everybody had gotten kind of used to a low yield environment. Well, now you've got high rates and you've got rising rates, and most people that would have looked at this thing would have said, hey, we are going to have some inflation, which means we're going to have to raise interest rates, which means that eventually this is going to filter down to the bonds, and they're going to have higher interest rates, which means that my older bonds, the bonds I'm already holding, the price of those are going to be driven down. That's not good, right? Especially if you're in a position where you need to sell them. See SVB Bank, as we talked about earlier in this episode. So when I say hold bonds short, in a rising interest rate environment, you want to make sure that you are as competitive with the interest rate and the yield that you're getting on those bonds as you can. And that's sometimes hard to do in a long-term bond market. I'm not saying don't ever go long on bonds, just sometimes when it's a rising interest rate, don't get too attached to them. Look at things that have a little bit shorter maturity times. On the converse of that, on equities, sometimes it's better to hang on if you've got a quality holding. So, all right, folks. Well, great question. Thank you, Nicole and Daphne. Folks, that's it for us here this week in Coasting in Retirement. I want to give a huge thank you to my lovely co-host, Michelle Lee Melton. A thank you to our awesome radio station, 106.5 FM. Many thanks to our provider of our show music. That's local band Sloth Racer. Sloth is in the slow-moving animal. Sloth Racer. Their music's not slow. And as always, my sincere appreciation for all of you out there that have been listening and joining us on this journey. We'd obviously love to be a part of your journey as well. Until we talk again next Sunday, have a wonderful and productive week. This has been Coasting in Retirement with Josh Knoll.
Advisory products and services offered by investment advisor representatives through Prime Capital Investment Advisors, LLC, a federally registered investment advisor. PCIA at 6201 College Boulevard, Suite number 150, Overland Park, Kansas, 66211. PCIA doing business as Prime Capital Wealth Management and Qualified Plan Advisors. Certain services may be provided by PCIA affiliates. In this format, Josh Knoll provides general information, not individually targeted personalized advice, and is not liable for the usage of the information provided. Exposure to ideas and financial vehicles should not be considered investment advice or the recommendation to buy or sell any of these financial vehicles. This information should also not be considered tax or legal advice. Past performance is not a guarantee of future results. Investments will fluctuate and when redeemed may be worth more or less than when originally invested.